we see this in the market time and time again since 2010, where we see the pullbacks are quick, they're rapid, and it's like, holy cow, man, I can't believe this thing's down 25-30%. I mean, it's not like 2000 where the dot-com era, that bubble bursted, and it was like 2-3 years, like just an 80%, 75% decline in Nasdaq over like a 2-year, 2.5-year period. It's it's not fun. This is like, it happened so fast, things get wrecked. The Nasdaq fell, the index, right? The Nasdaq fell more than 10%, but then it bounces back 4%. The Solar 10 ETF was down 6%, I believe, on Monday, and then up 7% on Tuesday. How does that make any sense at all? Suddenly, all these people like, these are overvalued, we got to get out of them. And the next day, we got to get back in them. Just the rotation is amazing. And now that we have the stimulus passed, right? I mean, it seems like, these catalysts, low interest rates. Yes, we're seeing long rates go higher, but it just seems like more catalysts where people are more optimistic. But it's funny how a couple of days makes where, I was watching a lot of the media and they're just, going crazy, stocks are crashing. Now everybody seems like, oh, everything's okay again.
Yeah. That's a great point. You hit the nail right on the head, because what we need to, as investors and just individuals, is we have to train ourselves or condition ourselves to get in that mindset, because things are going to be pulled forward faster and more volatile going forward because of the actions by governments and central banks. And this is a tight, spring being coiled for years and years and years. And I think that's a great point. The reason those recessions and pullbacks don't last as long now is because there's so much more money, there's so much more liquidity, there's so much more hands in the pot going around. And I think that that's going to be expected. I didn't even realize, because I don't look at Tesla every day like everybody else in the financial media, but you pointed out, hell, it was down 36% from its highs up until yesterday, when it went up 15% in a day. Those moves, like you said, it's amazing. I mean, it's hilarious. But so keep in mind proper position sizing. And this all really started, Frank, on March 1st. That was when the big rally came, the 600 point in the Dow. That was when I was traveling back. And do you know why and what kicked off this massive market rally?
Tell me.
The Democrats threw the poor people under the bus again.
I knew that was coming.
Because what happened before the stimulus just got passed, or is in the process of being passed, the Senate passed it, kicked it back to the House. I think they're doing it literally right now. But on that Monday, the 1st, is when the Senate rejected the $15 minimum wage. And what happened? Markets rallied. Because, of course, markets are only for the rich people, which is why everybody needs to get in the market so you can be rich. Duh. But businesses saw that a huge cost from the government, and even penalties. If the minimum wage wasn't allowed in, Bernie Sanders and some others were going to try to pass a bill to penalize companies that didn't pay up to $15 an hour. When you remove that massive risk off the table, that allows businesses to look forward a little bit more and keep the wolf away from the door for a little bit longer. So that's when this rally initially started. Interest rates, we can go there if you want to, but I had to point that out now that the stimulus is passed.
What's interesting about the political, and I hate politics, both sides, because usually when I talk about, Democrats, people are like, oh, you're super conservative and this. And no, I call it how it is. I like real people, and on both sides, they're not real. I mean, a good example of this is how, the Georgia runoff, right? And that was control of the Senate. And all of a sudden, they took polls and said, okay, these people want that minimum wage higher, 15. And that was a big deal. And Democrats really pushed that. And all of a sudden, the Republicans are like, oh, wow, these polls might be right. And then they're like, all right, we got to push. No, we believe in that too. The 15, we believe. All of this is complete bullshit. All of it's bullshit, right? So they get the election in. Now they come down to it, and they're not going to raise the minimum wage, whether you agree with it or not. It's just amazing how they use that as a tool to get elected on both sides. It didn't work out because the Republicans were late to the party because they didn't look at the right polls, and congratulations to Democrats. But now, congratulations. But you know what? Do what you freaking say what you're going to do once, just once. You know what I mean?
No. That's not the game, Frank.
I mean, even if, again, it's going to hurt a lot of businesses if you raise that minimum wage. I get it. I'm just saying, but just, not that I agree with that specific policy, but I do like people who just whatever you say you're going to do, just do it. We're in a world where everything's tracked media. We see who's bullshitting. We see it. And it's just amazing. Like, they don't even care, right? It's just, I don't know. But let's get to interest rates. Interest rates are moving higher. People worry about inflation, right, Daniel? So, and I explained this, and I did, my newsletter, which is going out later today to Curzio Research Advisory members. These are two risks a lot of people worry about. And I'm going to tell you, the market doesn't crash if you could see those risks. We all see interest rates going higher. You have yield curve control that's going to come if it goes higher. It's not just me saying it. You've seen the way they fixed, they kept those long-term rates. Jeffrey Gundlach, guy, it's unbelievably brilliant, one of the greatest bond guys. A lot of the bond guys, big name bond guys, are saying the same thing, that yes, that could definitely happen. It hasn't happened since World War II to fund that debt, or just to cap it. And now we have inflation going higher, which we all see. Now, we didn't see in 2008 the housing crisis. A few people saw it, and even the people who saw it didn't understand the full extent that everything was like on AIG and they were insured. And yeah, she's like, sure, this is easy money. They didn't even know, right? The whole system was going to collapse. They didn't know how crazy it was. Nobody knew to that extent, because it wasn't just like people think subprime was the reason. The market. It wasn't subprime. It was a small part of the market. It was the leveraging, the huge amount of leveraging of these subprime assets, which means housing prices only had to go down a little bit for the whole entire market to crash, and then it was just a ripple effect all the way through. Then we see the pandemic, something that, again, nobody really predicted how crazy it would be and spread U.S. and how many deaths and things like that, and the market fell sharply. That's when you see markets crash, but you see interest rates ahead of you. You see inflation ahead of you. These are things we see, guys. It's not these risks that are going to bring down the market. What brought it down over the past couple of weeks was the massive surge immediately. We never see a move like that, 1%, 1.5, and it's just crazy in a 10-year. But I would think that there's got to be other risks. If you really think this market's going to sell off with low interest rates, the new stimulus bill just passed, or basically passed, it's hard to suggest that, there's money that's going to come out of they can come out of technology stocks.
Yep.
And they're going to be rotated, but they're being rotated into cyclical names and travel related names, which we've been well ahead of that trend. But I'm not seeing money. And even when you look at the inflows, outflows, and things that companies that we follow, like the Bank of America, that track trillions in assets, you're not seeing those outflows. You're just seeing it from different sectors, but not completely like out of the market. But there's got to be other risks that really crash this market. It's not going to be higher interest rates or inflation, because we actually see that. We could see it coming.
Yeah, and it's talked about all the time. I agree with you on that. I would take this opportunity to look to the TLT is the symbol. It's the iShares 20 plus Treasury bond ETF. It invests in longer term treasuries, 20 years or more, just like the name implies. It's down about 20% because interest rates have spiked quickly. And if you notice, a lot of people aren't really talking about the yield 1.5, which is the same as the S&P 500 dividend rate, give or take. They're talking about why and how quickly it rose. So if you keep things very simple, Frank, the government, the interesting thing to watch will be the reaction, because money is emotional. So the government literally is in a position where it cannot allow interest rates to go very high. Why? Because we're running such massive deficits, you would have to borrow billions and billions and billions on top of additional money just to pay the interest as interest rates move up. If you think that's going to happen willingly, then you're not paying attention. But when they come out and they announce yield curve control, or they announce Operation QE or twisting or whatever the hell they're going to call it this next time, the reaction will be what you have to pay attention to. Short term, it'll be hard to believe that things don't get back to normal as a status quo. Rates will stabilize or go down, just like who's the Tepper? That was a great interview with Tepper, or I guess it wasn't an interview, but they were given bullet points with CNBC. But this is a situation where yields have spiked. It's got everybody's attention. It made everybody nervous. Now do the difficult thing and look to gain exposure on that and profit off of things getting back to the Willy Wonka.
Yeah, it is pretty crazy. And I'm not saying to go buy ESG companies that have gone up tremendously with no earnings power at all. Space companies as well. You're going to see a lot of these things. They've come down a little bit, but there's just so many good names. Like even in technology, if you're looking at the Avagos, you're looking at Facebook, at the valuations of these things and how fast they're growing. There's a lot of names that just got thrown out with everybody else. Yep. And they're not all the same. They're really not. So you're going to see that separation. You always see that everything comes down, but that's the best opportunity, right? You want to buy things that are cheaper. Now you can go and say, wow, Avago's getting this thing done. NVIDIA, the chip shortage, supply chain stuff, it didn't impact them at all. Not only that, you're seeing massive crypto demand. I don't think you saw that story with the ant miners, right? So you need these specific systems that are produced by Bitmain in order to mine for cryptocurrency. And they're out of them. They're completely out of them. They're going to be out of them until August, probably later than that. And you're looking at Taiwan Semiconductor, who makes the chips for those. They're like, last time they got caught up in this trend where they were generating like $400 million just from this trend alone in 2017. So they went on this massive supply. We got to produce like crazy. And then the market crashed and they had all these orders. And they're like, we're not doing that again. So this supply thing, yeah, the demand supply is going to be out of balance for a while. But, maybe you're seeing that's the reason why you see cryptocurrencies go higher. But NVIDIA, getting back to that point, is they have the graphic cards, which is an alternative. Not as good as the amp miners, but now you're seeing that business take off.
Yeah.
And they didn't say they're seeing that where, there's other chip companies that said the supply chain is going to hurt us. You've seen auto companies, again, they're getting thrown out as well. So, a lot of these names, yes, they're expensive, but some of them are coming down to good valuations where it makes sense to buy.